Welcome to Focus on Fuels, brought to you by StoneX. Your hosts are Trevor McClanahan, Risk Manager, and Alex Hodes, Director of Market Strategy from the StoneX Energy Desk. Alex and Trevor help fleet managers, fuel buyers, and energy procurement specialists gain control of fuel costs, boost margins, and keep their businesses competitive. Join them for another deep dive into the volatile energy markets.
Remember that the trading of derivatives such as futures, options, and over-the-counter products or swaps may not be suitable for all investors. Derivatives trading involves substantial risk of loss. Past results are not necessarily indicative of future results.
Hey everybody, welcome back to Focus on Fuels. I'm your host, Alex Hodes.
Hey, and I'm Trevor McClanahan. We are back and the market has been insane. We are a little delayed on our scheduling here, so we apologize for that, but we're going to get back in the swing of things, make this a little bit more weekly if we can, if not every other week. So this is a good time for us to step in and talk a lot about diesel markets. Today is November 18th, 2025, and diesel is up 15 cents on multiple factors. So we're going to touch on a little bit of all that, give you a quick crude update, might talk a little bit about propane, and then wrap things up. And if you guys obviously have questions for us, please reach out. But what are you seeing right now, Alex?
Yeah, so I think the first thing really has been diesel tightness. So diesel up, 14, 15 cents. NYMEX heating oil, European gas oil was kind of leading the way and kind of pulled up NYMEX heating oil along with it. There are several refineries that are down. Quite a bit of refining capacity is offline in Europe. One of the biggest is the Pernis refinery in the Netherlands, and that is set to come back online within the next few weeks. So there's around 1 million barrels per day offline currently, but about 600,000 barrels per day are set to come back online within probably about 3 or 4 weeks. And that could ease some things, but for the time being, we've really seen kind of a crunch on diesel supplies from the refining side, and particularly stepped up attacks from Ukraine on Russian oil infrastructure as well. That's kind of expanded to outside of just refineries, but also crude oil terminals, specifically in the Black Sea. So it's kind of a multitude of factors, and I think there's some volatility that's been amplified by just kind of positioning as well.
Yeah, definitely. And, and the fall is always kind of a sensitive spot for diesel, especially. We talked on the last podcast, we did anticipate some more sensitivity on that market in general. We felt that crude was going to be soft, and it's remained fairly soft as of recently. Really, the refined products market is driving, especially diesel. It is really drug crude up a little bit, and it's kind of keeping it above that or right around that $60 a barrel level on WTI. So we, at least for myself, I expect that crude does get back in the mid 50s or stay in that higher to mid 50s range. Just with all these additional barrels coming online from OPEC. I anticipate that continues, but now where diesel is at this point, we were pretty bullish last time we were talking, just in front of this European refinery turnaround season. The U.S. had one as well that was pretty minor, and then Dangote, obviously having their issues and the Russian attacks, Russian refinery attacks. So, like you said, it's just it's compounded on itself and created this environment where diesel is just kind of running away right now. At this point, I think it's more of a short squeeze on diesel than it is just the fundamental factors of what's going on. And, from October figures, you may be able to correct me on this, but I believe that Europe imported the most diesel that it's ever has. In the past. So that is as of October, and don't quote me on that one because I don't have the numbers in front of me on that, but I know that they were hitting close to record levels in October. So, we expect that to ease once these refineries come back online. One specific refinery that we're going to keep an eye on is this Pernice refinery, Shell refinery in the Netherlands. It's a 404,000 barrel per day crew unit, and it pumps a ton of diesel out. So that one is expected to come back on the 23rd of November. So just a few days from now. And obviously it's going to take a little bit for those inventories to rebuild and, that this deficit cool itself off some. But I do think that once this buying pressure eases up, we could be in store for a pretty hard sell-off on at least the front month of diesel. But the curve right now is extremely inverted. So it's definitely just kind of a front couple months. The first 3 months are really getting bid up right now. But the 2026 levels still are around that. If you look at the strip value there, it's probably still 230 or 235, somewhere in that range. So I wouldn't jump ahead and panic buy that right now, in my opinion. If you're looking at the forward contract market, I think that you should probably wait for this thing to cool off some.
Yeah, I think that's a good point to understand there, is that when you do see most of that market action on the front end, it has a lot to do with kind of positioning response, I guess. And that would be, like, obviously the front months are always the most active, but when you see such volatility on the front while the back end is still somewhat muted, it's kind of less of a it could be interpreted as less of a longer term bullish action. So, and I think that kind of goes hand in hand with what we're saying, is that the refinery outages should ease here, and that should kind of bring down some of that pressure. Another signal that kind of tells me the same thing is that, so diesel's up 15 cents. Crude, last I checked earlier today, it was flat on the day. So crude is not being dragged up aggressively. So you're not really seeing more fundamental strength on the crude side. So
that creates a really, really high margin environment for these refineries, because they're obviously, all their inputs are staying pretty settle. And then, all their outputs are hard to rally in a bunch. So that naturally brings back these guys. It's a free market environment, right? So anybody that's a refinery, they're going to be chomping at the bit to take advantage of this high margin environment, which just means more output. And then naturally that should kind of bring these levels down to some degree. Now, these refineries have to come back online on a clean scale, and sometimes that is a little bit of a choppy system there. So, we got to make sure that they're staying on schedule. But I mean, for myself, and I think that you are in the same camp, it's like somebody's going to take advantage of this. It's just a matter of who can and who will.
yeah, and one of the kind of, in 2022, we saw kind of a large refinery constraint issue, and similar price action. Crazier price action in that year. And what really kind of came to the rescue eventually was Chinese diesel exports. So there are still fuel export quotas available coming out of China. So they could fill that void if need be. And I think if the money's there and the capacity is there, which there is, it's just going to, those higher price environments, like, the cure for higher prices is higher prices. So if somebody's going to come in and fill that void, and whether it's going to be sustained is the next question. That's kind of where we both kind of say that we think that this is going to kind of come down, and prices are going to kind of sell off into the end of November into middle of December. So that's kind of the anticipation from a oil supply perspective. Obviously, geopolitical risks still lie. So diesel is still more at risk. One, with its inventories being relatively tight comparatively to the rest of the oil complex, and also the Russian oil infrastructure that's been under attack. Seems like the Ukrainian drone attacks could be something that's kind of a more medium to longer term price risk there. So
Yeah.
it's hard to be outright bearish on diesel, honestly.
Yeah, and I think that what we're saying here is it's not necessarily a long-term, and I'm definitely, I think that the diesel structure in general is just going to have these really sensitive points throughout these kind of cycles, and it's going to have, where when prices get in that 220, 215 range there, that's a good time to really buy it, in my opinion, because it's just a super sensitive product right now, and it's for simple measures. I mean, we've seen 2 refineries that are going to be closing domestically here in the U.S. and California. I'm off the top of my head, I don't know exactly what the barrels per day on that is, but it's pretty substantial. I think I want to say it's around 400,000 barrels per day that's going to be shutting down there. So that's a big chunk. And then we've got some European refineries that are closing too. We just had one, looks like in August, a 207,000 barrel per day crude unit is closing down in England. So yeah, that's another major factor there. There's less refinery capacity online now than there was a year ago, and that's going to obviously continue. Dangote is expected to expand over the next 3 years, but that's just going to take time. And until that they make that move, I would expect it could be more refinery closures in the meantime. And the reality is the gasoline market is the driver of those refineries a lot of times, and there's just simply a diesel. Diesel kind of gets left by the wayside. So while gasoline margins are obviously not quite as good, there's just this shift obviously to the EV network, and diesel is going to be higher as a result of that.
Yeah, and I think that's it's almost like a structural problem that's been occurring over the past several years and there's several kind of aspects of it. One of which being the closure of refineries in kind of the Western economies. So the U.S. is seeing refinery closures. Europe saw 400,000 barrels per day closed in 2024. And then you're seeing newer refineries come online elsewhere. So the Dos Bocas in Mexico, Dangote in West Africa, in Nigeria. And then you're seeing some kind of lighter end refineries coming on in China, other Asian markets as well. So, and the Middle East as well. So it's kind of a shift. So some countries are still investing in that refining capacity. So ultimately, refining capacity is expected to grow over the next several years, but it's kind of a dislocated market. So you're seeing kind of the refined products getting squeezed a little bit more so on these in the U.S. as well as Europe.
Yeah, and I think that actually paints a picture of what the anticipation is for those markets, because I think that those countries in the U.S. and then in Europe, like you said, the West, we're starting to see some closures there, which there may be some gasoline, there lighter demand on gasoline for sure. And then these new refinery expansions or new projects in general, those markets probably don't utilize as much refined products at the time. So their demand is likely going to increase along with their supply. So to me, it still paints this picture of a diesel deficit. I don't see us getting out of this until Dangote really is the main one, because it's such a big one, until they really get back online. And I think we're going to be in an inverted diesel market for a long time. I don't really know. I don't see any light at the end of the tunnel on that.
Yeah, I think maybe, we could go through a very short time period like we did in the spring, where we saw kind of a short flip to contango, but it doesn't seem like a sustained market that's going to go back to carry anytime soon. But kind of shifting over into crude, we are seeing kind of a much flatter market. So that's where we're seeing this big divergence from crude oil and refined products. So the more supply is coming online at crude, OPEC is expanding their production, and that's kind of expected to continue moving forward. And although they did put a pause on bringing barrels back online in January, they are still kind of the suppliers that are sitting on the sideline, and they're kind of there to balance the market. And they believe that they're right now they're still expecting kind of a surplus in 2026. And that's kind of why they halted these production increases in January. But still, the fact that there is this production capacity that's sitting there waiting in the wings essentially has prevented crude oil from really shooting up substantially, as opposed to when these refined products, that constraint is kind of allowing refined products to run quite a bit more. But on the crude oil side of things, I think our expectations are below $60 per barrel into next year. The EIA, IEA, and OPEC are all expecting surpluses coming in 2026, and I think that's being reflected in the structure of the crude oil market right now.
Yeah, I think that's interesting, and the big question at this point is the timing of the low point. That I think there's a majority definitely of investors out here that are thinking that crude's going to stay under 60, but it's a matter of like, when is that turning point? Because I think everyone, I've also seen a lot of chatter about 2027 being kind of this shift from a deficit, maybe not, or from a surplus, I'm sorry, maybe not into a deficit, but definitely a little more of a pinch on supply, and that's just a response of this low price environment for the producers. We beat that one home as well on this podcast, but it's going to really come down to the big swing producer, which happens to be the U.S. And then how the high to break evens are going to be when it comes to that point, and when they're going to start slowing things down some. So that's the big factor for me, is that timing. And I think that the market is typically forward looking to some degree. So if you start seeing some cracks in the surface of U.S. production, which I don't think we're quite there yet, I think the market's going to be forward looking, and then it might just naturally kind of inflate the market to some degree, add a little bit of a premium because it's kind of knows that that's coming, and it could be in the future.
Yeah, and I think one of the constants of the oil market over the past probably decade has been the expectation of U.S. crude oil production. The expectation is that it will finally slow down, and we still have seen it kind of outperforming expectations. Yeah, it's not growing as rapidly as it had in the past, and so that's still a kind of factor that's providing somewhat of a floor there, but we haven't seen like a drop off in production really. Like, there's been a couple months where I believe it was from April to May, or May to June rather, around that time period, where we saw $55 crude, and we saw basically a stagnant crude oil production level. But with the expansion of, there's several factors that are kind of allowing crude oil production to kind of stay resilient. One of which is there's been consolidation on the crude oil producer side. So a lot of the bigger guys are kind of stepping in and either acquiring other companies and just bringing in better technology, so being able to be more efficient. And in addition to that, we've had a lot more crude oil exports over the past several years. Our refined product exports are moving higher. And then another factor, and this is kind of separate than the crude oil side of things, but we're becoming just a much larger petroleum exporter in general. And that has kind of helped producers in the U.S., just players in the U.S., kind of be a little bit more resilient than they had. And I'd say kind of on the kind of a shift to kind of the NGL focus and propane focus is that we're seeing expansions of LPG capacity, export capacity, and we're seeing kind of a rapid amount of production growth on the NGL side of things too. So there's really been kind of an increase in petroleum production, but it's not really coming from the crude oil side as much as it is kind of now from the NGL side of things. So it's just kind of there's a lot of ways that these producers are kind of extracting the most value out of the ground right now, and they're not really seeing these pain points yet. So perhaps if we did have a sustained lower price environment for a lot of these products, that's when we're going to start seeing that pain. But we haven't really seen, a sustained level of those lower prices.
Yeah. Yeah. And I also think that at some point, just a natural phenomenon is the lower the price gets, the less commercial hedgers are going to be out there looking to short their positions off and lock in those margins, because there's not much margin to be locked in there. So it would be interesting. We got to pay attention to the CFTC report, which we haven't had eyes on in the last couple of weeks with the government shutdown. So that's been one factor that we have not been able to monitor. But in 2026, that's going to be a really big point for me is really watching the commercials, because it is a little bit muddy in the petroleum space where commercial traders, there's a lot of different baskets that they can fall into, right? But I think that the overall consensus on that will be whether or not those guys, once they stop hedging up their production, that will be a really key sign for me to start saying, okay, this is a good time to start. This could be the floor. Might not be, but it's going to be dang close.
And I think what will be interesting coming years, rather, will be kind of the shift of, like, right now we still are the marginal producer and kind of a big source of production growth still. But when that starts to shift towards kind of some of the other producers like Guyana, Brazil, Canada, and we're already starting to see some of those kind of take hold of being kind of bigger players in the oil, the global oil supply balance. So it'll be interesting to see how kind of the dynamics change. But really right now it's just much of the same of production is still exceeding capacity, or is exceeding demand growth for the time being. And there's a lot of production capacity on the sidelines still coming from OPEC, but they're kind of chipping away at that right now. But
yeah. Well, let me throw you a curveball real quick, because you follow this a lot, and so do I. But what do you think on the economy, on the current economy right now, the forward-looking economy, and then what that kind of results in for oil?
it's hard to
Loaded question.
Yeah, it's hard to kind of, and this is kind of outside of, I would say, our expertise.
Yeah, definitely, but still perspective.
Yeah, for sure. And I think there are like cracks in the economy that appear to be showing up on kind of just the labor market. But we have yet to really see anything with regards to inflation. So with crude oil prices and energy prices kind of facing some downward pressure on the crude oil side of things, not necessarily, we just talked about how diesel prices have run up, but crude oil accounts for a large portion of inflation data. And so how the Fed will respond to that data, I think they've still got some run room of cutting rates. So, and I think that will be somewhat supportive of the economy over the course of, a longer term perspective. But really we haven't seen, total demand destruction on kind of the U.S. oil demand side of things. It's been kind of like stagnant. We haven't seen a substantial amount of growth, but I don't see that kind of changing either way, really. Honestly, I almost expect a lot more of the same.
Yeah, and I think that my biggest concern is the inflationary. Let's going back into an inflationary environment, and just because the jobs data is going to take precedent over inflation, and if that continues to be the jobs data continues to be weak, then we could be in another inflationary environment. I don't have a really good feel for that, like somebody that's an economist, but that's my general view on things. Is and that inflationary is not only going to boost kind of the oil price naturally, but it will boost significantly the input costs for those oil producers on all the steel that goes into this, right? So that's might drive up that while the efficiency is going to get better on production, it also is going to impact the if the input costs are just higher, then it's just naturally going to be, higher regardless how efficient these guys can get.
Yeah, it'll kind of be a balance or a battle of, cost of capital going down. And then, but then will that result in higher prices overall? So it's kind of this, we keep going back and forth. And I think although, we have seen this inflationary past five years, I think one takeaway or one consistency in those inflationary periods is that they go through these boom and bust cycles of inflation. So,
Yeah.
We saw that burst in 2022, and then, there was, the deflationary period in 2020, then 2022. I think throughout those time periods, you just go through those huge cycles of inflation. And I think that's definitely a risk, but whether it's going to be 2026 or 2027, I feel like it's going to be dependent on kind of the production capacity of crude oil overall and the demand, those kind of shifts in demand and shifts in supply. And that's what ultimately leads to kind of those spikes. But, it seems like we're in that a similar time period where you're seeing, we're still in an inflationary decade, I would say.
Yeah, and I mean we're also through this quantitative easing cycle. Now we're into that where we're in tightening for a couple of years there. So yeah, it is interesting to me. I don't know what is in store, but I still am very strong on the point that I think 2027 prices across the board will be quite a bit higher, crude, refined products as well. That's a long-term view, so there's a lot that can happen in the meantime there. But to me, that's what that's what the yellow brick road is showing right now.
Yeah, I think that's the permeable speaking in us. We got to look all the way out into 2027 to see higher
fights. Yeah, and I mean that's not to say I still think 26 could see some spikes, man. And I on diesel especially, going back to that sensitivity. I mean that is a really big factor right now. And I don't think that should be taken lightly. If we get prices inside of, if you see the NYMEX prices inside of, I would say 220.
Yeah,
I think that's pretty good value. Maybe that might not be the low of the year, but it'll certainly save you if you're working on a budget on fuel prices. If you're a farmer, construction company, whatever you might be, you're utilizing diesel. There's been a ton of spikes this year. There's been 3 or 4 different events where we've seen really, really high diesel prices. And I think that will continue, where we just see a lot more volatility in that market. So if you get those lower prices, take advantage of them, in my opinion. And then it'll kind of keep the gray hairs out of your head.
I think ultimately we might have been somewhat more, cautious about diesel prices, a month ago or so, where we thought, it's coming into the fall, this turnaround season, prices could go higher, but I don't think we thought prices were going to go up 20%, over 20% at this point from October to November.
We just pointed out that it would be a more sensitive market, right?
Yeah,
there could be more spikes.
And so that's, I think, the ultimate takeaway from what we say. Things could change tomorrow. There could be some geopolitical issue if OPEC completely backs up and wants to do a production cut of 3 million barrels, but the market could get turned on its head so quickly. But understanding what these potential risks are and where the risk lies and how to kind of play that market is what's more important. I think that's kind of what we're trying to point out, is that this diesel is just going to be a little bit more sensitive because of these structural issues, the current inventories. Although they've, honestly somewhat improved, it's still just, we're short diesel overall.
Yeah, and that's going to be
it's just a structural issue.
Yeah, exactly. It's not something it's not going to get solved in a year. It's not going to get solved in 2 years even. It's going to take a while, and it may never get solved with this gasoline EV transition, apparently. So, I think that's a good. Do you want to talk about propane? Anything? We're good.
I think propane's been pretty boring. We can get it at the
sideways
to the next one, but really it'll be kind of a weather dependent market. But
diesel to some degree too.
Yeah, and honestly, right now I think on the propane side of things, it's almost the exact opposite of what we're saying about diesel. Is like there's been a lot more productive capacity geared towards the NGLs, and there's a lot of this demand that's been in Asia that they're building all this capacity in China, and the demand just hasn't. There's a large amount of petrochemical plants that want to take in these barrels, and but the market is just kind of flooding with propane right now, and that's a lot of it is having to do with just the crude oil production and getting gassier and more kind of NGL heavy. So it's kind of been depressed while the rest of the markets, the refined product market, is kind of taking the lead. But we can definitely talk about that next time and kind of our outlook of what we're hearing on weather. We're not weathermen, so we'll do our best to kind of take in the best expert advice there is out there and what the market expectations are.
Sounds great. Thanks, guys.
Thanks.
You've been listening to the Focus on Fuels podcast with Trevor McClanahan and Alex Hodes, brought to you by StoneX, NASDAQ ticker SNEX, a global Fortune 100 financial services company with a century of commodities risk management experience. Subscribe to Focus on Fuels on your preferred podcasting platform. For insights on managing fuel and energy price volatility, and to sign up for the free StoneX Morning Energy Brief newsletter, email focusonfuels@stonex.com or visit www.stonex.com. Please feel free to rate, review, and share this episode with colleagues. Until next time.